Okay, this is part 2 of a video series. I want to explain the basics of investing. So in last video, I answered the question, why do we invest? And the answer was this thing called compound growth, where we let our money grow slowly over time, exponentially through compound growth. In this video, I want to talk about how do we invest and some of the things that some of the vehicles we'll use to actually do this investing. I want to also point out that this is a video that's talking about investing for retirement. So there's definitely short-term and long-term investments that you can make. In this video and most of these videos, I'm talking about investing for retirement. So I'm not talking about investing for a few years to try to make some additional money to maybe buy a car or buy a house. Those are totally valid things to be doing. But in this video, I want to talk about investing for retirement specifically. So how we put money away slowly over the course of our working years so that when we reach, retirement age, whatever that is for you, you have a large sum of money so that you can pay all your expenses, your housing and your food and your car and all these expenses in life without actually working. So this is a video about investing for retirement. And so there's a few different retirement accounts that we're able to use. And so essentially the government has created these accounts. So what's called an individual retirement account, or you'll hear referred to as IRA. This is an account that the government has created that has some tax advantages that allow you to put money away slowly and surely and be able to retire. So the government wants us to retire, right? So they're allowing us to use some of these tax advantages through these accounts. These are all different accounts, all these things right here, such that you can retire. And so retirement accounts are IRAs and 401ks. You can also have what's called a brokerage account, which is not under the term retirement account. It's very similar. It doesn't have some of the same tax advantages, but these three things are essentially the three types of accounts that someone could have. So these are kind of types of accounts. These three bullet points here. So you'll hear people referring to all of these different things. So I'm going to talk a little bit about what they are. So right here you can see I have Roth IRA and traditional IRA, and that goes the same for 401ks. So you can have a Roth 401k and a traditional 401k. And this is all a little bit confusing. Even to me, it's still a little confusing on when I should choose a Roth versus a traditional. Should I use my IRA or my 401k, or should I use both? So essentially, if you were to Google Roth IRA versus traditional IRA, there's two kind of differences between them. So with a Roth IRA, we're going to read this together. With a Roth IRA, you contribute after-tax dollars and your money grows tax-free, and you can generally make tax and penalty-free withdrawals after the age 59.5. With a traditional IRA, you contribute pre- or after-tax dollars. Your money grows tax-deferred, and withdrawals are taxed as current income after age 59.5. So this is confusing, right? Like, this doesn't make that much sense. So I'm going to try to explain this a little bit. So basically the difference between a Roth IRA and a traditional IRA is that in a Roth IRA, so what is a Roth IRA? It's an individual retirement account that lets you invest post-tax money. So what I mean by post-tax money is you have an income, you're working as a nurse, let's say, you have an income, and the government is already taxing you on every paycheck, right? You look at your paycheck and you have federal and state taxes always, right? So we're going to take some of the money that has already been taxed and it's in our bank account, and we're going to put that into our individual retirement account. And And what this Roth individual retirement account is going to allow us to do is pay 0 taxes on any gains in the future. So we're going to take that money that we got from our paycheck that was already taxed, buy some investments within this retirement account, and then if those investments grow, which they very likely will if we leave them in there for long enough, any growth that we see from those is not going to get taxed. So this is the big point of retirement accounts, is that they have tax advantages, tax advantaged account. We won't pay taxes on our gains for a Roth IRA. I use a Roth IRA and a Roth 401k. It's hard for me to say whether you should use a Roth IRA or a traditional IRA. A traditional IRA is different in the sense that before the government actually taxes your income, so before they actually can tax some of that income, you could put some of that money into the account before they can actually tax you, and therefore the taxes are going to be less total for you, because you've kind of stored some of this money into this account before the government has applied the tax rate to it. And I'm not going to explain too much the difference between a traditional versus a Roth. I want the point of this video to be that essentially you could use either one of these accounts, or you could use a combination of both of them and save money for retirement. And it's pretty specific to your specific case of where you're at in life, and what your income is now versus what you might think it's going to be in retirement. And it's not always the most clear, but luckily for us, if we use either one of these things, we're probably in a good case. So let's talk about the Roth versions of these. This is what I'm currently using. So let's just talk about it. So a Roth IRA is basically a vehicle, not an actual investment. So it's somewhere we can put money that the government has allowed us to put this money into, but it's not actually an investment. So within the Roth IRA, we're actually going to have to put our money into investments. So for example, we'll probably buy stocks and bonds inside of a Roth IRA. So the Roth IRA itself is not actually an investment. It's an account that the government allows us to have such that they can give us some advantages so that we can retire. And you'll see right here, once you turn 59.5 years old, you can begin to take your money out without paying taxes. So by design, these accounts are retirement accounts, and so they want you to leave your money in for a long time. So if I've put money into this over the past few years and will continue to, and my plan and goal is to not ever use this money. So I don't want to take it out ever. I want it to sit in there until I'm in retirement at 59.5 and take it out. And so that's the point of these retirement accounts, is that they want you to put your money into these accounts and let them grow over time until you're able to retire, and then use these tax advantages to actually retire. And you might question, well, what if I never reach 59.5? And that's a valid point. So that might be part of how much you actually put away every month in your decision. There's a whole side of emotion and values in investing that are very personal, and that this is kind of why it's hard to just have a blueprint for any given person on investing, because there's so many different variables that can change in your life, and what you value with your time and your money. You might say, rather than putting money into this retirement account, I'm gonna go use it right now to do something fun that I love in life, and that's a totally valid argument. So at some level, you're gonna have to determine how much money you value for saving for retirement versus how much money you want to use and have. So with that being said, these accounts, the government give us these accounts because they want us to be able to retire. there's a lot of rules. So let's talk about some of the most important rules. You can only contribute $6,000 per year. So essentially, if you were able to put a lot more than $6,000 per year, like, hundreds of thousands of dollars, these gains that you might have in the future could be ridiculously large. So the government is capping how much you can actually put in there. So in 2022, this is actually 2022 stat, $6,000 per year is the maximum. In 2023, this is actually going to be $6,500. So essentially, this amount per year is kind of adjusted with inflation in a sense. So, it might go a few years at 6,500, and then, it might go up to 7,000 at some point in the future. But so right now in 2022, it's 6,000, but in 2023, it's 6,500. So next year we'll actually be able to put $500 more into it. But the point is, you can't put a ton of money into it. They only allow you to put $6,000 per year. Here's another important rule, what we would call a rule. They're gonna charge you 10% on taking out any profits before this age of 59 and a half. Don't ask me why they use 59 and a half as the age. I think it's kind of bizarre that they do that, but that's just what they've determined I don't know. That's just what they've determined. So if you take your money out before that age, they're gonna tax you a penalty. So the goal is to not do this. The goal is to let this money sit in there for a long time, grow over time, and then take it out when we want to retire. And so right here I have some very similar notes on a Roth 401k. So a 401k is very similar to an IRA, but it's employee sponsored. So your employer will actually kind of create this account, and you can talk to some people through your employer about putting money into it and what you can invest in it and stuff like this. I currently contribute to both a Roth IRA and a Roth 401k, and a Roth 401k is very similar in the sense that the government taxes you on the money you're making from your job, and then I'm putting that money that already got taxed into this account, this Roth 401k account, and I'm buying investments with that money. And the idea is that those investments are going to grow over the long period of time, and then those gains from the growth of my investments are going to be tax-free. So I'll pay 0 taxes on those gains in the future. Again, it has that 59.5-year-old rule with the 10% penalty. Again, the Roth 401k is a vehicle, not an actual investment itself. So you actually have to buy stocks and bonds and actual investments within this account. So you could put money, cash into this account, but not actually buy anything, and you would be kind of missing out on the point. So this is a vehicle, not the actual investment. In the next video, we're going to talk about what are some of the actual investments that you would buy. The 401k you can contribute in 2022 up to $19,500. So that's a lot. I know I sure can't hit this maximum. I'm not going to reach that maximum. I did choose to reach my maximum for my Roth IRA, but I won't be able to reach this maximum. But you very well could. If you're making $120,000 a year, whatever you're making, you might be able to hit that fairly easily. There's probably people that are making salaries of $500,000 and stuff like that. So this might not be crazy to them, but to me it's far too high. So I won't reach that, but that's fine. It's just where you're at and what you do with your money. Similar 10% penalty on withdrawals before this age, this retirement age, essentially. So these things are tax advantaged accounts. So there's a reason we want to take advantage of them, is because the government is essentially saying, use these so that you can retire. You want to use these. They want you to use these also. So I have this last note here, the goal. basically the goal, in my opinion, and I think most people would agree, is that you want to automate monthly payments, or some payment over the course of the year. Typically it's easiest to do it monthly, into your accounts, these retirement accounts, and let that money grow and not touch it until you're able to take it out at 59.5 or later. I have highlighted automate here because I think this is a super important point. The best way to go about this is to set up a system and have a plan and a process and a system that every time you get paid, let's say, you take some small chunk of your paycheck and you put it into these accounts. So every time I get paid right now, I'm putting money into my Roth 401k, and every month I have a Roth IRA that on the first day of every month, first business day of the month, I put $500 into some investments within these accounts. So that's why I say automate is very important, because otherwise you have to, every month or however often you have to think about this stuff and decide, okay, how much should I put in right now? But if you make a plan and have a system, and do some budgeting and have a plan, this becomes way more straightforward, and you're actually aware of how much you're going to put away and what that could do for you. So I hope I've explained some of the basics of these retirement accounts, and I'm going to talk more about them in the next videos. But these accounts are important to understand, and you'll have to do some of your own research on some of the nuances and some of the rules and all these things. I'm going to leave links to the IRS's websites the IRS's rules in the video description so that you can look at them. So essentially right up here I have IRA contribution limits, and you can see that this one has $6,000 in 2022. And I also have some 401k rules and stuff like that. So the IRS has all these rules and stuff. And if you want to look more into them, I'm going to leave these links in the video description. But I want to end the video with one last example from this compound growth spreadsheet where we turn from this bum into this boy. So let's say let's say I want to max out my Roth IRA. So $6,000. So that would mean I'm investing $500 a month. So $500 a month times 12 months is $6,000, right? So let's say I invest $500 a month for 38 years. And let's just say I start this, next month. So I don't have any initial investment. I'm going to assume that I'm going to get 7% return on my investments. And so if I did these things, 7% return, $500 a month for 38 years, retirement, I would have over $1 million. And guess what? This $1 million is going to be tax-free because I'm taking advantage of a Roth IRA. So I'm putting the maximum contribution every year into a Roth IRA, and look at that, I have $1 million that is all mine, and the government can't take any of it. So this is very possible, and look, I've only contributed $230,000, but because of using investments to grow my money, I have $1 million now. So this is an example of using these accounts to essentially have a retirement fund. And let's say I want to get more aggressive in a sense with my investments, my retirement investments. Let's say I put $1,000 in every month. So maybe I put $500 a month into my Roth IRA and then max it out. And then I also want to put $500 a month into my 401k. So I put $6,000 into my 401k. Nowhere close to this $19,000, but still a lot of money. And now look, I now have $2 million. I've contributed less than $500,000, but I have $2 million that is tax-free. So the benefits of these retirement accounts is that because this money is tax-free. So if I weren't using these retirement accounts and I was buying these investments outside of these retirement accounts and I did the same exact parameters, this would have taxes on it, and the tax rate would depend on a lot of things, but it could be on the order of 20, 30, 40%. And essentially what that would mean is you could lose out on $300, $400, $500,000 somewhere, somewhere in that area. And so that's why these tax advantages are very important. And this is why you'll hear a lot about retirement accounts, so IRAs and 401ks. So yeah, I hope that video explained a little bit about like what these actually are. So these are retirement accounts, right? And how and why we essentially use them to have money for retirement. So this is where this $2 million is coming from. You turn from this bum into this boy, and never forget that.